Hello, hope you're all doing well. Let me first start by apologizing for the issue with the video uploads that I know I've had some technical challenges the last few times. Had some problems with the size of the files, so I had to try to put those in YouTube and make a link there. And I think I've got them working now, and I had a duplication of the files, so my apologies. Thank you for letting me know. I would rather have you tell me than you all guessing or trying to guess what was going on with that. Second thing I want to mention is that the homework that was posted before spring break, it was chapters 11 and 12. I had already put it out there. I failed to change the dates appropriately. When I did think I changed them, I think I put the wrong month, but they now are set up to be due on Monday, April 6th. So you have a little bit more time. Last chapter, we talked about life insurance policies, the types of policies are out there. So this chapter, we're going to talk a little bit about the different provisions that exist in all types of policies. There are a lot of commonalities. Some of them are more attributable to whole life insurance policies because they are unique to cash value and payout clauses. So we'll talk about those, and then I'll try to mention when they are more attributable to whole life versus term. So I'm going to turn over and share my screen with you. Well, I'll get that loaded here. Okay, so let me scroll back to where very beginning. My apologies here. Thought I was on the right slide, but okay. So first thing I want to mention is there's a common clause in any insurance policy, whether it be term or whole. It relates to ownership. Who owns the life insurance policy? Typically, it's the person whose life it's out on, but it also could be a spouse. It could be a business partner. Sometimes businesses take out policies on their executives. So the ownership essentially says whoever the policyholder is, they have the contractual right to decide while they're living what they want to happen with that policy. The most common thing would be they get to name who is the beneficiary, who's going to get the payout when they die. And they also usually get to choose what they expect the payout to be. Is it a one lump sum payout like you can do with the lottery, or do you want it to be spaced out over time? So they get to designate that. And they also have the opportunity, if they are the policyholder with their ownership, to transfer ownership to another party, which we'll talk about a little bit later, when that might be something would be considered. Talk a little bit about another provision that's real common is the entire contract clause. So when you create a life insurance policy, it's an agreement between the life insurance company and yourself. And part of that application process is you filling out a questionnaire, a summary about your health, how old you are, what are your family history, medical history, is there cancer or heart disease or diabetes in your family. That plays into what they think your life expectancy is. They also take that application, and in conjunction, they make a policy based on those assumptions that they take from that application. So those two pieces represent the entire life insurance contract. They're relying on that application because it has information that is tied directly into the life insurance policy. Having this entire contract, and we'll talk in a minute why it matters, is that it prevents the insurance company from making amendments without your knowledge, and it also protects your beneficiary so they cannot come back later and say that they're not going to pay a claim. So one of the main reasons is, and it ties in well with the incontestable clause, it states that the insurance company has a certain period of time, usually it's 2 years, where they can contest the policy. Maybe you apply, you lied about your age, you lied about a health condition, and they find out about it. They have 2 years to detect that fraud. After that 2 years, they can no longer contest the policy was fraud or fraudulent or inaccurate. They have to pay it out to the beneficiary And that protects your beneficiary from them denying a claim later after your death. You may have been the person who lied about something, but that's not fair to the beneficiary who's expecting that money, and it would cause a financial hardship. There are a few situations where they could contest it, and they'd be pretty rare. They either could contest it if the fraud that you've committed on that application is so egregious and so outrageous that the payment of that death benefit would be against public interest. The first being is, let's say you are the beneficiary, you took out a policy on your spouse with the intent of murdering them to get a payout. Now that right there would be, if they can prove that, that would be probably a contestable situation that they would not have to pay out on. And the second thing is, let's say you completely fraudulently tried to place this policy. Maybe you were on your deathbed, you had cancer, but you had somebody else stand in for your health exam and lie who they were. And if they could find that out, that would be another reason for them to throw it out. One that most people are familiar with is the suicide clause, and this is standard in every policy. So if you take out a policy and with the intent of, I'm going to commit suicide to provide financial support to my family, if you do that within 2 years, commit the suicide within 2 years, then the face amount of that insurance will not be paid to your beneficiary. And so they won't get, let's say you take out a $100,000 policy, they won't get that face value, but they will get a refund of any premiums that you paid in. It's a very common, if you happen to wait until after the 2 years, and I assume most people know that provision is there, they will have to pay it out. So that's that waiting period. Another real common provision would be the grace period. So a lot of people forget to pay their life insurance policy, especially if it's not set up as an auto payment. I like to have it set up as an auto payment so I don't forget about it. But if you forget to, they have to allow a 31-day period for you to pay that overdue premium. So if you were to die in that grace period, they still would have to pay out the insurance policy. So it's interesting to know that if you ever have a situation where the insurance company tells you that your family member didn't pay it, so it's expired and you don't get the benefit, you need to check and see what the period of time was. You have something called a restatement provision. So let's say you do let your insurance policy lapse. Maybe you didn't have the money, especially now with the financial crisis we're facing, people lose their jobs. They're more worried about they're paying their mortgage and getting food on the table and paying for medical expenses. They're probably not going to be worried about life insurance. So easily they could let their insurance company policy lapse. So let's say they get back on their feet in a couple of years and they decide, I liked that policy. I already had some good provisions. I want to go ahead and restate that. A lot of policies will let you do that, but there are some requirements that have to be met in order for you to do that. First one is you may have to subject yourself to another evidence of insurability, which is another health exam. Your health could have changed over that period of time. Maybe you didn't lapse because of financial reasons. Maybe you just decided you need it, but then later on you decide, you know what, I need that policy because I'm sick or I have a health condition. Another one would be that, let's say over that period of time, and the longest period you typically can go, there's a period of time that you can do this. It has to be within 3 to 5 years typically. So let's say you didn't pay your insurance premium for 2 years because you couldn't afford to, and then you want to restate it after those 2 years. You are going to have to go back and pay the previous premiums that you would have paid plus interest on that. And so why would we have to do that? Well, your insurance company, you want to restate it to where it was based on your age and based on the value you set. That is a calculation, actuarial calculated amount that they need to collect from you over a period of time, and they expect to earn interest on that money to be able to make the investment appropriate. So you do have to catch up. If you had any loans that that weren't repaid, you would have to either pay the loans off or you'd have to reinstate the loan, whatever that value was. If you ever decided at some period in those 2 years or 3 years before you reinstated that I'm just going to cash it out, obviously it's no longer there, so they're not going to let you restate it. You'd have to give them all the money back to do that. So you might as well just start over. Like I said, it has to be within a certain period. And it is a huge outlay of cash because you remember, you're going to have to go back and pay all those overdue premiums that you didn't pay, and you're going to have to pay all the interest. So a lot of people do not have the financial ability to do that. However, let's say you were down on your luck and you had a period of time, but then you get a really good job and you can catch up. What would be the benefit of reinstating it instead of just buying a new policy? Well, there's a couple things. When you reinstate it, you don't have to start the clock over on a couple important provisions. The first being that incontestable period where they can say, you know what, you gave me fraudulent information and I have 2 years to figure that out. I can contest the policy at any point in those 2 years. Well, let's say you had the policy for 5 years before you let it lapse. You would not have to start the clock over at 0. You've already met your obligation for 2 years. They didn't contest it then, they cannot come back and contest it now. And the second piece would be you've already passed the period of time for the suicide clause to have passed, so you don't have to start over at 0 again. One of the biggest disadvantages that I already mentioned is it's super expensive, but sometimes you can buy a better policy. So it's important for you to shop around and really do the analysis, I should say, before you decide to do one versus the other, because it is expensive. Another interesting clause is, what if I decided I lied about my age or my sex in the application? Well, we all know that if you lie about your age, it can make a huge difference on the amount of premiums you pay. And if you're a male and you lied about being a female, you're also going to pay less premium. So if that is the case and they find that misstatement, they're going to make you pay to them the amount that you would have paid based on the correct age and sex that should have been put on the application to begin with. Most important thing most people are commonly familiar with, and this is common in both types of term or a whole life, is who do you want the beneficiary to be? That's the person you name to receive the policy proceeds after your death. There's several different classes. There's the primary versus contingent beneficiary. There's the revocable versus irrevocable beneficiary, and there's specific versus class. So there's 3 different classifications. What's the difference between primary and contingency? First being, if you are the first named beneficiary, you're the person who's going to get the entire proceeds first. So common example of that would be a spouse is typically the primary beneficiary. You have young children and you have a spouse. You want your spouse, if they're still living, to get the entire death benefit to take care of the children. Then you probably also want to name a contingent beneficiary. So what if you your spouse would be the primary, but you both die together in a car accident? Your contingent beneficiary could be a grandparent, could be your children, could be a trust, but you have named someone who, in the event the other primary beneficiary isn't living, that they would get the benefit. The second class is a revocable versus irrevocable. So most common would be revocable. We mentioned at the very beginning, if you own the policy, you can name whatever beneficiary you want. You can change it 20 times. If you wanted your sister to have it and you change your mind, you're mad at her, and then you decide to give it to your brother, you can change that in a revocable. You do not need their permission to say, it's not like a will, but you can change your will as well. You can't change it without, you can change it without their permission. You don't need their consent. Irrevocable is set up where you cannot change it without their permission or consent. Why does this happen? Well, if you're a spouse and you're still married, you don't want your spouse going along and changing the beneficiary and taking you off of it. You have the rights to that, and so they can't do that. And you both have to agree at the beginning that this is how you want it set up. You want an irrevocable. A lot of times people hear about irrevocable trust. That means you can't change it if it's set up with both parties involved and you have an understanding of how you want it to be carried out. Same thing with this. And the last classification would be a specifically named beneficiary. You actually put their Social Security and their name on the life insurance beneficiary form. Or you could say, I want an entire class. Maybe it's all of my children that are living, or maybe I only have one child so far, but you don't have any children in the future. And so rather than have to go back and amend the life insurance, you could just say all of my living children, whatever that might be at the date of your death. What about changing your plan? You bought a plan, you thought a universal life policy would be the best thing based on what you anticipated using it for, and kind of find out that you decide that you don't like that plan, it doesn't meet your needs. You could always go back and exchange your current policy for a different contract, something that fits your needs better. That is usually fine, with the exception of that gives you flexibility. Maybe your family needs have changed, but there's two things you can't change. You usually cannot get rid of the suicide clause, that 2-year period, and you typically cannot get rid of the war clause. So those two things cannot not be changed. So they all have those exclusions. A few policies out there actually have some high risk exclusions, things such as aviation. So if you're a pilot, you have a higher probability of dying in an airplane accident there, or could be a high risk sport like skydiving or hang gliding, or you could be a race car driver. Sometimes some life insurance policies have provisions that exclude coverage for those type of activities. So that's another thing to consider. Premiums can be paid annually, semi-annual, quarterly, and monthly. I typically do monthly. Makes it a little bit more economical, and instead of paying one big lump sum. But you do have to pay a slight amount higher if you don't pay it all at once, just like with anything, like with auto insurance. If you pay it all once a year, you get a better rate than if you pay it monthly. But so you have to look at what's the most feasible for your budget. If you decide to do an auto deduction, like I mentioned, you actually get a discount by having that done. Same thing with auto insurance. If you have it automatically withdrawn and paid all up front, you get a discount. You also get a larger refund. So if I set up auto payment every month, when I get that dividend payment or a refund at the end of the year, I get a larger refund for having it set up that way. So we talked a little about, you could assign your life, even though you're the policy owner, you could assign your life insurance policy to someone else or some other party. So when and why would you do that? So there's a couple ways. Could be that you want to use it for collateral on a loan, or it could be that maybe you want to donate your life insurance policy, which typically would be a whole life in this case, that has cash value or some investment value to a third party. It could be a charitable organization, a church, it could be an educational institution. You want to give them the rights to that. There's two different assignments. It can be an absolute, like in the case where I'm going to give this entire policy to the church when I die. They get full rights, they can exercise them, and they never have to come back to you for follow-up. With the collateral assignment, the only reason you're giving it to the third party is because you owe them money. And it's basically like having a collateral on a loan. You put your car up, your title for your car, and that serves as collateral. Once you pay the loan off, then they no longer have right to the title of your vehicle. Same thing with this. It has a value, and if something were to happen and you died, if it's a $100,000 policy but you only owed them $5,000, or that's your remaining balance, they're only going to get what they're owed from the loan, and anything left over would go to your beneficiary. So it's only a partial assignment. At any point, and I think this was mentioned in the video last time, you can borrow money on a whole life insurance policy. This is not the truth. You cannot do that with a term policy. So if you decide I want to borrow cash because for example, right now I'm on hard times, I lost my job and I put a lot of money into this life insurance policy and I need to figure out a way to cash it out, or maybe I want to pay for a down payment on a house or for education for my children, might be something you could withdraw. If you do that, you typically have to pay interest on that loan. And if you recall, a couple of those videos mentioned that, why would you do that and why would you want to pay interest on your money? Well, technically that's not true. The money is not yours. As I mentioned earlier, when they set up a actuarially based payout, they say, based on your age today and when you're expected to live and how much I'm supposed to pay out, this is how much I need to collect each period. If you take out money, that's money that is not sitting in the bank in their reserve to earn interest. So they are not earning what they should have earned. They're letting you do it, but they're not getting what is owed them. So thus you need to pay it back with interest. This is money that they would have earned interest on. Hope that makes sense. what are the advantages of a loan? Obviously, you don't have to do a credit check. You can usually get a lower interest rate. You don't have to do a fixed repayment. Maybe you can pay it out over a period of 5 years, and you can pay it off earlier if you need to. But it gives you some flexibility. You don't have to go get that bank check and credit check. Disadvantages, the policy could lapse and you may actually own more and it won't leave your beneficiary what you need. Also, it's hard to catch up when you have to pay back that interest. So it may not be smart, just like it's not smart to borrow against your 401k because it's hard to recoup those values that are lost. If you decide to do an automatic premium loan provision, essentially what that means is if I fail to pay my insurance premium or I can't pay it, I could have that premium deducted from my cash value if I fail to pay it or I can't pay it. Again, not a good practice, and try not to do that. That would be a better financial choice to not do that. So dividends, this essentially is a refund. Every year, I call it a refund, but it's essentially a dividend payment that is due to me, and I can choose multiple ways to take that out, which I'll talk about in a minute. If a policy is going to give you money back, it's allowing you to participate in the earnings and the good performance that they had for the year. A non-participating policy, they get to keep all the benefits to themselves. So when you're shopping for a policy, it's really good to find a participating policy. Dividends that they're going to pay out to their policyholders come from 3 main sources. One, they had better than average mortality experience. So less people died than they anticipated based on the actuarial tables. Secondly, they may have earned more money on the reserves than they anticipated. It's not going to happen over the next few months, but prior to that, we were having great financial performance in the market, and they probably were earning higher than expected interest earnings. They're usually pretty conservative on their estimate. So if they do better than the average, they're going to be able to apply that back to their policyholders. And the last one is they are more frugal and economical and actually have reduced their annual operating expenses. So they've reduced overheads, they cut people out, and they have more customers served by less employees. So if they actually save money, that's money they can put back into the pockets of their policyholders. So there's several different ways you can take out dividends. You have a choice on this as well. You can take cash, and like I said, on mine, I typically get a lump sum. I don't have a whole life insurance policy. I have a term. So for me, the cash is nice and it automatically goes back in my account. Another option would be, I don't want to pay premium. I can turn and roll it over into a premium that's going to be coming due, so I don't have to pay it. That's another really good option. Another one would be, you know what, if it's a whole life policy and I'm actually accumulating investment value, I could take those dividends and take that and earn interest on it and continue to grow at a faster rate. No different than a 401k. If you take out money every time you earn money in it, you're never going to grow the account. Same thing here. You could have it roll over and earn interest. The question for you would be, am I going to earn a better interest rate in this particular life insurance investment versus somewhere else I can invest it? You also can apply whatever monies are there to pay up on a whole life insurance policy so that you don't have to worry about paying it out in future years. You could take it, the portion that you gain, and you decide to buy an extra add-on term insurance policy, which is possible. And also if the policy is mature, so this is kind of got a weird mature policy, but if the policy is mature, you can actually create an endowment. So I've already paid in all I need to pay. This is extra money, but I want that money, instead of going in my pocket, I want to like give it to an educational institution so they can maybe give a scholarship to somebody or apply towards another option. As I mentioned before, dividends or refunds are never ever guaranteed. It all depends on whether they have better than average mortality experience, they have better than average earnings. So usually it's not guaranteed. I mentioned that in the 15 years that I've had my policy, I probably have gotten at least 48 to 55%, somewhere in that range. But if you have a really bad economic downturn like we're experiencing now, or we have a large catastrophic event where more people die, likelihood is that the refund or dividend payout is going to be much lower. I'm going to talk a little bit about cash payout, but I'm going to do that in the next slide deck, kind of break this up. So I'll see you on the next slide, on the next video that I post, and talk to you soon. Have a good evening.